Okay, so we'll do a brief review. Actually, that was today's. This is today's. We'll do a brief review of those first two journal entries. I think we got to. Did we get to the third one? I think we might have got to the third one. But we'll do a review of those. Remember, we've got 4 journal entries that we're really concerned with in this chapter. 2 of them happen at the time that payroll occurs, and 1 of them happens at the time that we make the payment of taxes or any of those other types of like garnishments, things that have been withheld from employee paychecks, payroll items that the employer owes, and then the last one happens at the end of the accounting period to make any adjusting entries. So we'll do a quick review of those first, because I think we got through the first 3. And then we'll talk about the last one as well. Let me get my downloads. Yes. Let's take a quick peek back at the remember, we're going to get, in order to make the first journal entry, which is recorded at the time that we pay the employees, and it is, the recording of it is all the information that pertains to the employee paycheck. So anything that occurs on the employee paycheck, and I should say all employees, so all together, so the gross amount that they are paid, the amount of withholdings that occur from their paychecks, and then ultimately their net pay as well. So that's what is encompassed in that very first journal entry. Remember, we're going to debit the wage expense. So if we take a look at this journal entry, we're going to take our first debit of wage expense is the gross amount of payroll, right? So remember, our debits means left, credit means right, and we've got wage expense. And remember as well, we have to have at least 1 debit and 1 credit for every journal entry, and all of the debits and all of the credits have to equal each other. So we have to balance on both sides of this. So because this is our gross amount of pay, $18.45 is our debit. Now, it's not the amount of cash that's going out, but we are debiting wage expense, so we're increasing wage expense in this example. We have then amounts that are going to be withheld. These are going to be credits because these are payables. So we have OASDI, we'll call it payable. So these are liabilities, so they have a normal credit balance, $114.39. HI payable of $26.75. We have employee, EMPLO, federal income tax payable in the amount of $170. So all of these amounts were withheld from employee paychecks. And then we've got employee state income tax payable of $50. And then it looks like we've got insurance. I think they called it insurance collected or something like that. Collected of $191. All right. And then the amount of cash that is going out is the net paycheck. So cash goes out, $1292.86, and all of these will equal then down here $18.45. That means all of our credits should equal $18.45 as well in order to get those to balance, which they do, $18.45. But good idea to always double check that and make sure that is the case. So there's our first journal entry, everything having to do with the payment of the employees. Second journal entry, so there's that. Second journal entry, remember, pertains to the amounts that the employer owes for that same pay period, right? So the employer's share of taxes that are owed. So again, where's the, over here. Still going to have our debits and credits. We've got different accounts that we're going to hit. But in order to record this particular journal entry, we've got some different accounts here. Again, these pertain to our gross wages. We're going to debit payroll tax expense. Now, this is, remember, this is the one that's kind of a plug. So we're actually going to do this last, but we know it's going to be a debit in this case. But we're going to make the entries for all of these other amounts first. So we've got FUTA payable of $369. We've got SUTA payable of $4606. OASDI payable, whoops. And of course, this is the employer's portion of that OASDI, $114.39. And we've got HI payable of $26.75. Now, we don't have a cash entry on this journal entry because we're not paying any cash out at this point. We're just recording the amounts that we owe, that we are going to owe. And when we do make the payments for these taxes, then we will debit those accounts with these same amounts, right? And that will essentially zero out. So in order, like I said, in order to get to our payroll tax expense, we add all of these up first. So let's just add those up. $190.89. So that's how much we need for our debit up here, $190.89. And we balance. There's our second journal entry. Questions about either of those? Are we pretty clear on what that entails? Okay. Cool. Now, the third, where are we here? Journal entry occurs when we actually make the payment of those, what's it here? Here we go, recording the deposit. Okay, so if you recall, when we made the first journal entry, we also had a credit to OASDI in the same amount, because that's the employee's portion that they had withheld and that they owe. And then we had a credit entry to Medicare taxes payable as well, also in the same amount. But then we've also got to pay the rest of these, the amounts that are liabilities. So what we have to do, and these are, so they've got the totals here for us of what is owed. So that $228.78 just comes from this being multiplied by 2, right? So, and again, this times 2, so the employer and the employee portion of that $53.50. We have to think back to the last journal entry. We had that federal income tax payable of $170, state income tax payable of $50, and then we've got our FUTA payable and our SUTA payable. So we have to talk about the journal entry that we make when we actually pay those liabilities. And it's going to be in the form of a couple of different journal entries because the payments are going to come at different times, right? This first journal entry is going to record our payment, our deposit of those payroll taxes. Remember, the payroll schedule that we have, the payroll deposit schedule is going to depend on how much we owe. It might be the middle of the following month we may have to make this deposit. It could be that we have a next day well, with this amount, we don't have a next day deposit requirement because that would mean that all of this would equal over $100,000. Then we would have a next day deposit requirement. We may have a semi-weekly deposit requirement. When we make this payment depends on how much we owe and what the deposit schedule is that we are on. So you have to kind of remember back to chapter 4. Actually, I think we talked about it initially in chapter 3, that deposit schedule. So this is the journal entry that is made then on that day that we make the deposit of these payments. So we would then debit OASDI payable, or they call it FICA taxes payable, OASDI, for $228.78. So remember that other journal entry, we had a credit of $114.39. This journal entry, we have a credit of $114.39, which means in total, we have credits totaling $228.78. Those are liabilities that we're going to owe. Now we're going to pay them. So instead of crediting, we're going to debit it. That's going to zero it out. Then at this point in time, we don't owe anything, right? Same thing for the Medicare taxes. So $53.50, that is from both journal entries that we made, the employer side and the employee side of that liability. So the $53.50, again, we would have a credit in that account of $53.50. So now when we're making the payment, we're going to debit it, zeros it out. Because we've got $53.50 on both sides, that means our total is zero. Employee federal income taxes payable. So that's from the prior journal entry, that $170. This is going to get paid at the same time. All three of these are getting paid at the same time because they're all going to the IRS. Social Security taxes payable, Medicare taxes payable, and federal income taxes that we've withheld from employee paychecks, right? They're all getting paid at the same time. And then our credit is to cash, which again is kind of just a plug. We're just going to total all of these up, and that's the amount of cash. We're writing a check. Actually, we're probably making an electronic transfer to our IRS account in the amount of $452.28. And essentially then what that does is it zeroes out our OASDI, our Medicare tax, and our federal income tax payable. Now at this point in time, we don't owe anything. We don't have a liability anymore until we have the next payday, right? So that would be one. These are all the same type of journal entry. These are all journal entry number 3. It's just that the payments happen at different points in time. This next one is our deposit of state income taxes. So we withheld $50 from employees' paychecks for state income taxes. We held that money back. Now we've got to pay it to the state, right? So this is to record the entry for that payment to the state. Again, we would have a credit sitting out there. If you think about that first journal entry, we had credited state income taxes payable for $50. Well, now we're going to debit it. That zeroes out the liability. We don't have the liability anymore. And we're crediting cash. So we're paying that cash out. Remember, cash is an asset. Assets we debit to increase, but we're paying cash out. So it's going to decrease, right? So that's why we're crediting that. And then, so that's going to happen, whatever our deposit schedule is for the state. Whatever that agreement is, that's going to happen on that date. And then we've got our SUTA taxes payable. Again, that's our state unemployment tax. So it's going to have another different schedule. Maybe it's due at the same time as our state income taxes that we've withheld. Maybe not. We don't know. So SUTA taxes payable, that comes from here. When we accrued that liability of $46.06 now, and we had a credit here, now we're going to debit it for the $46.06. And again, we're going to pay cash out. So the trigger for these journal entries is we're actually writing a check or we're making a transfer. Something has happened. Some external transaction has happened that triggers the need for these journal entries. And in this case, it's that we paid cash out. Okay? So these are all part of the third journal entry. I call it one journal entry, probably a series of journal entries. These journal entries happen when we pay all of those liabilities that we owed. questions about those? So first journal entry is made when we pay the employees, and it records the amounts that we're paying them and the amounts we're withholding from their checks, right? As well as their net pay, what they're actually receiving. Second journal entry also happens when we pay the employees, but it's the amount that the company owes on their behalf. So the company's share of Social Security, Medicare taxes, accruing those SUTA taxes, FUTA taxes, all of that stuff. Third journal entry then happens when we pay those liabilities. But in all of these journal entries, we've made some sort of payment, right? There's a payment associated with it. So this is when we actually pay those liabilities. Questions? I guess here's the last one, the FUTA taxes. And this would have happened probably, I mean, if that's all we owed, we probably owe more than that. I mean, I guess in this case, it looks like we are paying it. Maybe we had reached that $500 threshold earlier, and so now we have to pay this at the end of the quarter. Otherwise, what would have happened is during the year, we would have accumulated more and more of a credit in that payable account. And if we're paying it all at the end of the year, it's going to be more than just that $369, because this only pertains to one pay period. If they're paid on a weekly basis, we'd have 52 pay periods, and that would have accrued a bunch of liability in that account that then needs to be paid out. All right. Questions? No? All right. So our last and fourth category of journal entry that we make, we don't have a transaction that occurs that triggers it. What triggers it is the end of a period, end of the month. So we're coming up on the end of April. That would be a trigger to make adjusting journal entries. For those of you that are in accounting, in 131 or 104, something like that, you've probably gone through depreciation. Depreciation is one of those journal entries that a transaction hasn't occurred. It has to be adjusted at the end of a period. Might be on a monthly basis, might be on a yearly basis. This is the same type of thing. We need to make an adjustment because our pay periods don't always match up with our accounting periods, right? If you think about, maybe we're on a weekly payroll cycle. Sometimes they will match up, but let's pretend for now that they don't match up. Best way to explain this is to actually pull up a calendar. Okay, so this is a good example, actually. We got the end of April here. So if we get paid on a weekly basis, let's just say like last week, we got paid on the 25th for work from the 21st to the 25th. Simple scenario here. So we got to pay, we worked these 5 days, and then at the end of Friday, we got a paycheck. This week, we worked the same. We still work 5 days, Monday through Friday. We're going to get paid on the 2nd of May at the end of that day. Well, our accounting period, though, ends on the 30th. On the 30th, we need to be able to accurately reflect what our expenses are for the month of April. But we don't record that journal entry until the 2nd of May. And it's overlapping 2 separate accounting periods. So we have a timing difference between what our payroll period is and what our accounting period is. We fix that by making a journal entry on the 30th to record accrued payroll. These are amounts that we're going to be paying on May 2nd that have already been, these are amounts that have been earned by the employees, but we haven't paid it yet. Okay? It's a timing difference. A timing difference between the accounting period and the payroll period, because they don't match up oftentimes. Now, if you're on a monthly pay period, let's say we get paid once a month, it's on the 30th, and we're going to get paid for the whole month, well, then that's not going to create a timing difference because it matches up with our month end, right? We're not going to have to make any adjusting entries to account for time that employees have already, or amounts that employees have already earned, but they haven't been paid for yet. Okay, so end of period adjusting entries are made, and they're necessary when the accounting period does not agree with the end of the payroll period. So this is an example of an adjusting entry for wages. So these are wages that have been earned. They're using the example of December. So maybe they're not, the end of the year has come, it's December 31st, but employees aren't going to get paid for another week. So we have to make a journal entry, though, that records what the employees have already earned in the month of December. So for example here, if employees have earned $2,400 by the end of December, but it's going to be paid in January, then we have to record that liability. We're going to record the wage expense of $2,400. They just made up an amount here. By the way, there's no calculation that went along with that. It's just $2,400. So employees have earned $2,400. They've worked it. We're going to have to pay it to them. $2,400, and then we are recording a wages payable. So we've got to record another liability. This is an amount that we're going to have to hand out to employees. It's just that we're not going to actually pay it until January. So we do not, though, record the withholding taxes. We just record wages expense. We record it as one lump sum there so this would be the gross amounts of payroll. So for example, let's say we've got, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, Saturday. Let's say this is the end of our accounting period. And this is our payday. But we have to record, we're not going to pay them until Saturday, but we have to record the amounts that they've earned during this time period. So if they earned, in total, and this is all employees together, $1,000, $1,500, and then on Wednesday, another $1,000. That means we've got to record that liability so that it's accurately reflected, so that the expense is accurately reflected at the end of the period. So we've got wages expense. So this would be recorded on, well, we'll call it 8/4/30, wages expense of, is that $3,500? And this is our debit up here. And then our credit is wages payable of, let's get this up here, $3,500. So that gets that expense on the accounting books in the proper period. Okay? The payroll department's responsibility would be tallying up and figuring out how much that wage expense should be. So they can tell that to the accounting department. The accounting department can make the journal entry in the financial records. Because payroll department should know, they should be able to collect that information from all the departments and determine how much wage expense do we owe at the end of this, by the end of this pay period. So we've got this recorded in the proper time period.
Is this only the 45?
Yeah, we don't worry about that right now. Yep. Because who knows what these numbers are going to be, right? But we do know what these numbers are. So we've got to include that then in that proper proper accounting period. We do the same thing with vacation pay I mean, depending upon the company. Like bigger companies, obviously publicly traded companies are going to keep track of this as well. So the amount of accrued vacation pay, maybe the account of accrued sick pay as well. If the company is required to pay out sick pay if a employee leaves, then they would want to keep track of what that liability is for that time. So here's an example of $1,000 of vacation pay that was earned during a period. It's going to be taken sometime in the future. Again, we're going to record that expense in the proper time period. And then we have a liability of $1,000. Then when the employee takes that vacation pay, we would debit the vacation benefits payable and credit cash because now we're paying it out, right? Same thing would happen here. So what we would do, we've got our wages expense here. Let's say they earned another $1,000 and $1,000. So as of Saturday, we've got our pay day. Now we've already recorded this wages expense, right, in the proper period, but we've got an additional $2,000 of wages expense to record of $2,000. So that's our debit. We have to then take this wages payable out, right? We're gonna offset that wages payable. There was a credit here. Now we're gonna debit it of $3,500. And then what's our credit gonna be? It's payday. We're giving people money. What's our credit gonna be? Cash, right? We're paying out the cash. And $5,500 is what we're going to pay out. Now it'd be a little bit more complicated than that because we would have to record those withholdings and all of that stuff as well. But that's how you fix then that. That's how you get that payable off. So now we don't have the payable anymore, and we've properly recorded the expense in each of the pay periods or each of the accounting periods. Sorry. Questions about that? No? Okay. So that's the end of the chapter. Do a little recap here. That's very loud. So we took a peek at the payroll register and the employee earnings record again and showed how that we need to use those reports in order to create these journal entries, especially the payroll register, right? That's going to be of utmost importance. Of course, we need the employee earnings record as well. We got to keep that updated. Talked about the different types of deductions. I think we did. Did we talk about the types of deductions? Well, we talked about how we record them in the journal entries. But let's see let me just do a quick cursory glance here. I guess there's some that okay. Some of these we have to look at. Different types. I mean, we've talked about these in general. So group insurance, we talked about the fact that the amounts that are collected are usually from the employees, are usually collected to reimburse amounts that have already been paid by the employer. So those bills come, the 1st of May comes, the employer is going to make a payment for insurance that will cover employees for the month of May. And then during the month of May, the employer will withhold from their paychecks in order to get reimbursed for what they've already fronted, essentially. But group insurance, and it just depends who pays it. Oftentimes it's a combined effort between the employee and the employer who actually pays those premiums. But that's one type of, might be voluntary, might be involuntary. It's usually voluntary. But there's sometimes when, and I guess they've separated out group insurance. Oh, this is life insurance. Oh, sorry. I was talking about health insurance there. Life insurance is usually voluntary if the employee wants to take it or not. Health insurance as well could be voluntary, but there are employers that require you to have some sort of health insurance. So if you don't take their health insurance, you've got to show them that you have health insurance from somewhere else. So again, premium is paid in advance, and then the employees will pay it back to the employer throughout the month by means of automatic withholding from their paycheck. Purchase of government savings bonds. So if you want to, some employers offer the opportunity for employees, and this is just a way of investing in savings bonds. So instead of taking your $100 out of the bank and going and purchasing, actually you purchase them online these days, purchasing a savings bond directly, you can have the money just automatically withheld from your paycheck, and then your employer makes the purchase on your behalf. It's not pre-tax, it's post-tax. So there's no tax benefit to doing it that way. It's just a matter of convenience and for those who want to save money in that manner. So that would be voluntary. This would be a voluntary withholding. Union dues depends on the state you live in, whether it's voluntary or involuntary. In the state of Iowa, you can't be forced to join a union. And you can't be forced to pay union dues. There are some states, though, where businesses can mandate that you have to join the union. But in Iowa, that is not the case. So these are for, they would be withheld from paychecks, again, not pre-tax, post-tax. So employees are not going to get any tax benefit from paying these union dues. But the amounts withheld would then be credited to a liability account. So at some point in the future, the employer, they're going to collect the union dues, and then they're going to make the payment on behalf of employees like they do with income taxes and FICA and Social Security and Medicare taxes as well. All right, garnishments. So garnishments are kind of a separate category. Garnishments are involuntary, meaning you are subjected to them whether you like it or not. Obviously, they're only for certain individuals. If individuals are in arrears or owe money on, say, child support, back taxes, certain other types of creditors, what they can do, if they're not getting payment, they can garnish wages. So this is where they send out a notification to the payroll department at the company to say, hey, so-and-so employee owes X amount of money. You need to withhold. This is what you need to withhold, and send it to us directly.
More than one creditor.
Mm-hmm. Mm-hmm.
So you might not have money.
Well, no, they can't take all of it. They can't take all of your paycheck. They can take a lot of it, but they can't take all of your paycheck. They have to leave you with something to try and live on. And there's a certain order for these garnishments. Certain ones have priority. So federal tax levies and child support come first. And as it says here, whichever is delivered first. So if somebody owes federal income taxes that they haven't paid, and they owe child support, whichever one gets there first is the one that's going to take priority. Okay, whichever garnishment notice gets there first is the one that's going to take priority. Bankruptcy would be next. So if you have filed for bankruptcy, but you have creditors, and I don't know the different types of bankruptcy. Some bankruptcy filings, you still have creditors that you're going to owe money to. But in bankruptcy, I guess Chapter 13, like I said, I don't know the details of bankruptcy. That would come next. So federal levies or child support, whichever got there first. Next up would be bankruptcy. Any bankruptcy claims would come next, because that would be a court order. Bankruptcy would be a court order. You've gone through the court system, and they've said, this is how much you owe to all of these creditors, and then the courts divvy up the monies that they collect to the different creditors. Last would be other types of creditors, so credit cards, car loans, those types of things. Student loans, student loans, if you don't pay your student loans, They can come after you and garnish your wages for the student loan payments. And then federal administrative wage garnishments. I don't know what that exactly would entail. Something other than federal income taxes if you owe something, some other types of fees or whatever. So that is the order in which they fall. All of this falls under the Consumer Credit Protection Act. That act limits the amount of wages that can be subject to garnishment. So the percentage of wages subject to garnishment is dependent on the type of garnishment. So student loan versus child support. So they can take more for child support than they can for student loans. The maximum amount of disposable earnings that can be garnished, and disposable earnings is your earnings after the required taxes are paid. 25% of earnings for the week. So if your disposable earnings are $1,000, they can take $250, or the amount which the disposable earnings for the week exceeds 30 times the federal minimum wage rate. Don't ask me to calculate that. That would be something that's calculated for you. So they would tell you, take this or this, whichever is less of those two, but not more than 25%. Social Security Administration also can garnish, without a court order, any delinquent overpayments owed by former beneficiaries of the Social Security program. So if you received Social Security benefits and you weren't entitled to it, and yes, it happens, they just send out checks, and you weren't supposed to, they can come after you for it and they can garnish your wages for it, ultimately. Child support. So child support is another type of garnishment, although, it could be a garnishment if you are behind on your child support payments. It also could just be that your child support is being taken out of your wages and directly sent to the administrator just for ease of payment, right? Just because it's easier to do it that way than to write a check or whatever every month. So they have to have immediate withholding for child support payments. The employer can charge an administrative fee, a reasonable administrative fee for their troubles of collecting it and sending it off. This takes precedence over most voluntary and involuntary deductions. So it's usually number one on the list. The maximum amount varies depending on other obligations and the number of weeks that the employee is in arrears. So if they're not in arrears, it's just going to be the amount that they owe every month. But if they are in arrears, meaning if they're behind on payments, then that amount can certainly be boosted over what their normal monthly amount is. Federal tax levies. So second after child support. Now they say second after child support, but then they also said whichever comes first. I think that in most cases that child support is going to come first, because remember, when an employee is hired, the state is immediately notified that employee is hired, and child support records are handled by the state, whereas the federal government is a little bit slower in getting that information about where employees are employed. But those two the two together take the highest priority. So this Form 668W is a notice of levy on wages that would come to the payroll department from the IRS, from the federal government. Employees will get a copy of all of those forms as well, so they will be notified. It won't be a surprise to them that they're getting this garnishment. The levy has to take effect within 3 days of the receipt. Why? Don't turn it off. Where are we? Oh. Where are we? Oh, shoot, come on. There we go. So within 3 days from the receipt of that notice with the first wage payment. So if you get the notice and the payday is the next day, you don't have to withhold on that payday. But if payday is 4 days out, you've got to withhold on that next payday. So the deductions for back taxes, child support, or bankruptcy do not qualify as deductions required by law. And what they mean by that is it's not like obviously it doesn't apply to everybody, but things like federal income tax withholding and Social Security tax withholding, all of that would be required by law. If the garnishment for these equals or exceeds 25% of an employee's disposable earnings, no deduction can be made to satisfy the second garnishment. So all of these come first. If that equals 25% and somebody still has maybe a student loan garnishment order, they can't take it. They can only take the amount that they've taken for these. Other types of voluntary, sometimes involuntary deductions, pension and retirement contributions. So oftentimes what happens is the employer will pay part of the pension contribution and the employee, and then the employee will have it withheld from their paycheck. Again, same story though as the other types of withholdings. The deductions from the paycheck are recorded as liabilities because the employer is collecting the money, collecting the contribution, and then they're going to pay it to the broker or whoever is handling that. The liability account is cleared when the employer pays the contributions to that financial institution. So these are things like 401ks, IRAs, any type of pension, retirement accounts, and that's how that goes. Employers do have a limited time, and I can't remember what it is exactly, but a limited time to transfer that money into the retirement account. And it's a fairly short period of time that they have to do that. And any amounts that the employee pays, that is their money. There are some vesting, it's called vesting. There are some vesting rules for certain types of retirement plans where the amount that the employer contributes may not belong to the employee for a certain period of time. So if the employee leaves employment, they may not be entitled to the amounts that the employer had contributed, but they're always entitled to the amounts that they contributed. But then after a certain period of time, if they're completely vested, 100% vesting means that they get all the money. The employee gets all the money, whether the employer contributed it or they contributed it, because they were with the organization for long enough. Let's see, what other things do we want to talk about here? So what happens when we have an error with tax withholding? So it happens. They're kind of a pain to fix, but it happens. So if it's a correction of over withholding, so you withheld too much money from the employee's paycheck, then you fix it in the same quarter so that 941 isn't affected, right? So you'll have to refund some of the money to the employee. You got to do it within the same quarter. If it's under withholding, a problem of under withholding, so you didn't withhold enough. Well, what is this saying? Wait a minute. I'm not quite sure what this is summarizing here. Hold on just a second. Must be something in your textbook. Hold up just a sec. I want to see what they say in your textbook because that confuses me. Ideally, you want to find those errors and correct them in the same quarter because of that 941. If you discover it though in a different quarter, then you're going to have to amend the 941 for the prior quarter in which the mistake took place. So from an accounting perspective, from a logistical perspective, it's less of a headache if you can find those errors as quickly as possible. I just want to see if your textbook said something else other than that, because that was kind of a weird. No, right there. Okay, so here we go. So over withholding, if you discover the correction in the same quarter, with over withholding, the employer is going to repay the over withheld amount or reimburse the employee by withholding less from future wages. They do not have to report any incorrect amounts as long as they fix it by the due date of the 941. If it's under withheld, so they haven't withheld enough, and they discover it in the same quarter, then the employer would report and pay the correct amount of tax on the 941 as if it were properly withheld, and then they'll settle up with the employee. So the employee is going to have to owe them that money back. If it's not discovered until a later quarter and it's over withheld, so if you've already filed that 941, the employer may either repay the amount or reduce future withholding taxes for the employee in that same calendar year. It still has to be in the same calendar year. So let's hope you didn't make the mistake in the fourth quarter and then discover it in the first quarter of the next year. You're going to have to record for Social Security tax errors. The employer will report both the employer's portions as an overpayment on a 941X. That's an amended tax return. So anytime you see the X behind a form number for the IRS, that means it's amended. You had to make some change. So if you had an amended 1040, there are 1040X forms out there. So that's what that X means. Overpayment would be credited toward the next quarter's form 941. If it's under withheld, so you haven't collected enough, the employer has to then collect the amount on or before the last day of the year by deducting it from their paychecks. So like I said, you have to hope that you didn't make that payment right at the end of the year. It does happen that errors are not caught until the next year's though. So, and that's, like I said, that's just kind of a pain in the butt. Okay, I don't need to go through too much detail here. These are just different ways that employees get paid. Cash, it does happen. Usually that's more the day laborers will get paid in cash. Check, electronic payment, so direct deposit, that sort of thing. There are some other methods though. Pay cards. Some employees can choose to be paid with a pay card, which is essentially just like a debit card. I see this more with like high school students and that sort, like college people who don't have to pay rent, people who don't have like car payments and stuff like that. So pay cards, just like you get it on a debit card. There are some disadvantages to that, of course. You are limited to how much cash you can take out, just whatever that debit card limit is. It's awfully hard to pay your rent. Most places won't accept debit cards for rent payment. It's cheaper for the employer. It's a really cheap way of paying employees. But you cannot, if you offer pay cards, you have to allow employees to receive their payment in a different manner. You can't just force people to get their pay on pay cards. That's not acceptable. And then electronic pay stubs. A lot of people will get their pay stubs, not only their pay check direct deposited, but then also their pay stub will be available to them online. So final pay, what happens with the final pay? It depends on the state that you're in. So I think California, so California and Minnesota require that the employee, once they're terminated, and I don't think it matters whether they're fired or whether they quit, they have to be paid immediately. So the payroll department better be ready to write a check that very last day. Some places like Iowa, you're just paid on the next payday. There's nothing special about it. Other states have other requirements, like within 3 days or something like that. There's no federal law that says you have to be paid within a certain period of time other than the next payday, right? So it just depends on the state. This one I do want to go through real quick. Unclaimed wages. There are people who receive a paycheck and then they never deposit it, believe it or not. It doesn't happen all that often, but it is true, yeah. So what happens is the employer has a year to try and locate that employee. Usually what happens is the employee's moved and they didn't leave a forwarding address, right? So it comes back to the employer, and employers make a lot of mistakes with this. So they do have to make an attempt over the next year to exercise due diligence and they've got to send certified letters. They've got to make a good attempt to locate that employee and get them their money. If after a year they cannot locate the employee, they've still got the money hanging out there, they don't get to keep it. It is not theirs again. And this is where employers will make this mistake, is they'll think, oh, well, it's just my money. No, what happens then is it has to go to the state. The state has an unclaimed cash fund. And by the way, so the state of Iowa has a website that you can go on, and I'll pull it up for you, to see if anybody owes you any money. It's called Iowa Treasure Hunt. This is where unclaimed property goes. Uncached paychecks are unclaimed property. So after a year, if you have not been able to locate that employee, you have to send the money to the state. Then the state will make attempts to locate that employee. They've got other resources that they can use at their disposal. But also what happens is you've got to give all the information, the name of the employee, their last known address, all of that. And then the employee, if they're savvy enough, can go on here. Let's see how many Murphys there are that have money that's unclaimed. All right, there's a bunch of Murphys that have money. I know my name's not on here. And you can see they don't give you exactly the amount that is outstanding, but like this under $100, I mean, that could be $1, who knows? Here's and over $100. So Amy Murphy, last known address is Ankeny, is owed a refund by somebody, we don't know, it says it's undisclosed, of over $100. So if Amy Murphy looked on this list and saw her name, she could contact the state. Adam Murphy? What were you saying? Oh, Lululemon. Yeah. So gift certificate, unredeemed gift certificate. So it just sits out there. So employers, this is where the money's supposed to go when they have wages that or paychecks that have not been cashed by employees. So you can go on there, the Great Iowa Treasure Hunt. You can go on there and see if anybody owes you any money. They've returned over almost $400 million to people. I don't know what time period that is, but so there you go. Let's see. Last thing. So payroll fraud that we'll talk about. Payroll fraud is one of the most common types of fraud in institutions. Because those in the payroll department are privy to a lot of very sensitive information. First off, you've got employees' names, social security numbers, addresses, phone numbers, age. You got all sorts of information that if you weren't an honest person, you could do a lot of damage. Also, there are different types of fraudulent schemes that people partake in. And they're not just people in the payroll department. Could be executives that are having the payroll department, unbeknownst to them, participate in these schemes. So identity theft, as I just mentioned, you got a lot of very personal information where you could steal somebody's identity. Buddy punching, so you punch somebody else in and out, right? They're 15 minutes late, you take their time card and punch them in. that sort of thing. I don't know how often how much time cards even exist anymore, but ghost employee. So this is a more sophisticated fraudulent scheme. This is where a fake employee has been created. Let's say Kelly Murphy is an employee, a legitimate employee of an organization, and I work in the payroll department. And I create an employee, I set up a new employee in the payroll system that is K Westfall Murphy, or just K Westfall. I got those two last names going, Westfall Murphy. So now I've got a K Westfall and I've got a Kelly Murphy, and I create paychecks for K Westfall. It's close enough. My bank has the name Westfall Murphy on it. That's close enough so that I can then cash those checks and put them into my account. So it's a ghost employee. It's an employee that doesn't exist. It's pretty common. It's it happens at all different levels, certainly. Next one, pay rate alterations. So if I'm in the payroll department and you come in, you're my friend, we go out to lunch all the time, and you haven't had a raise forever. You should have got a raise like ages ago. And you're like, hey, can you do a little something to help me out? I'm at $20 an hour. I really should be at 25. Look, Lucy over there has gotten all sorts of raises. So working in the payroll department, like, all right, I tell you what, you take me out to lunch for the rest of the year, and I'll just change your pay rate. So that's another type of payroll fraud that can occur, pay rate alteration. Some of these require collusion, meaning more than one person to do it. Some of them don't. Anytime you have collusion, though, the risk of getting caught increases. Anytime the more people you have involved, the more risk you have of getting caught. And usually, people get caught. They almost 100% of the time, eventually, they get caught. Worker misclassification. So that's sort of the same as the pay rate alteration. So, you're in the nursing department and you're a CNA, but LPNs get paid a lot more. So I'm going to classify you as an LPN instead of a CNA, that sort of thing. The best way that companies can prevent payroll fraud or any fraud at all is through checks and balances. And one of the best ways of doing that is to mandate vacation time. The number one way that fraud in general is detected is through tips. Somebody clues in, like if you have a tip line or something like that, that's the number one way. Another big way that frauds are detected is somebody goes on vacation. The payroll clerk gets sick. She's never sick. She's never been sick in her 14 years that she's worked here. She's such a great employee. She's always here. She is here early and she stays late every single day. And now we know why. Because she doesn't want anybody else seeing her work. So if you have somebody else, if you train somebody else in that job duty, and then you mandate vacations, you say, you have a week's vacation, you have to take it. You have to take it by the end of the year, which I know in America, we don't tend to do that. We don't take our vacations even when we have them. But that allows for other people to come in and look at the work area and see what's going on. That's how a lot of frauds are detected and uncovered, is somebody has filled in, the person perpetrating the fraud got sick and somebody else had to come in and do their work for them, and then they discover what's been going on. And it's not just payroll, right? All sorts of different areas, that type of thing goes on. So checks and balances. All right, and then these are the journal entries. Okay, we'll go back to the summary now. So we looked at the payroll register and the employee earnings record and how we extract the information to make those journal entries. We just talked about those different types of deductions, voluntary and involuntary. We went through all of the journal entries, those 4 different types of journal entries that we need to make that pertain specifically to payroll. Talked about how then after the journal entries are made, the transactions are posted to the general ledger accounts, those T accounts, right? Which accumulates information That information is then pulled out and used for the accounting records, the financial statements. Okay. We talked about the how we record those payroll tax deposits and those end of the period adjustments. Any questions? Okay. Well, that is all for the lecture part. Let me turn this off.